Hey everyone, welcome back to another episode of Boss Economics World. Today we're going to dive deep into how global economies have become increasingly chaotic, and honestly how certain governments, ahem US, have guided us through one policy debacle after another. You love to see it, or if you're working in finance and business like many of you, maybe you don't. Let me jog your memory for a second. Think back to the 1990s and early 2000s. Oh yes, globalization had everyone feeling like they had a front row seat to an economics masterclass. America was the big maestro. Wall Street made the moves and central banks around the world danced to the Federal Reserve's tune. Either that or faced capital outflows that could shake the foundations of their currencies overnight. It was the age of American economic dominance. Sanctions made America's opponents buckle under pressure while providing their allies with preferential access to U.S. capital, technology, and markets. Remember China, once an up-and-coming global economic player that eagerly cozied up to the U.S., boosting its rapid growth and development. Fast forward to today, and oh, how things have changed. The fractures, the cracks, and honestly, mismanagement are too obvious, and now everyone's asking the same burning question. Is there anyone at the helm who actually knows where this global economy is going? Let's break things down step by step and expose the cracks behind the facade of US-centric global economics and its wildly hit or miss, mostly miss monetary policies. Because while the situation may seem subtle and complex, the implications are dire. First, let's start in the land of the free-falling inflation management. U.S. economic challenges in the last couple of years are a testament to the Fed's ongoing struggle to control inflation post-pandemic. Inflation peaked, and when it finally showed signs of slowing, the Fed fumbled again. Too slow to hike earlier and too slow to ease later. And who pays the price for this indecision? Everyday Americans dealing with sky-high costs for everything from groceries to gas. Over in Europe, it's worse. Inflation? Check. Hurt by the Ukraine war cutting off Russia's gas supply? Double check. The result? Governments over there are scrambling as energy shortages push prices up, causing a squeeze on everything from manufacturing to household budgets. Germany, the EU's economic powerhouse, is even flirting with a recession for the first time in years. Germany just reported zero economic growth in Q2 2024. The stagnation is real, but the worst part? The global ripple effects are just beginning. Switch to China, though, and the picture changes. They're dealing with the paradox of low prices, and not for a good reason. No inflation means the consumer demand is simply not there. Long heralded as an engine of global growth, China's economic slowdown, combined with a dangerous real estate implosion, poses a far bigger problem for the global economy than many yet fully realize. And while central banks in North America and Europe are flip-flopping their way through the inflation fight, the Bank of Japan is defying the trend. The BOJ is raising rates after decades of deflation. This divergence is wreaking havoc on global markets. The Bank of Japan's unpredictable rate policy leaves the yen swinging like a wind chime in a hurricane. The result? Real market chaos, leading to heavy sell-offs and sudden gains that have erased billions of dollars for hedge funds and stock traders in the US, Europe, and Japan. When central banks don't act in concert, wild things happen. Let's look at one glaring example: Japan's currency, the yen. As of the first half of 2024, the yen hit a 30-year low against the US dollar, only to see it surge over the summer, dropping again shortly after. This roller coaster led to an astonishing single-day stock market collapse of 12% in Japan in August 2024, triggered by as much confusion as by panic selling. Why? The yen was being used in what's called the carry trade, where investors borrow low-yielding yen to pour money into higher-return assets elsewhere. But when the yen shot up, this cheap money trade became unprofitable. All that speculative money fled faster than you could tweet #recession-alert. The damage wasn't limited to Japan. The global aftershocks were vast. U.S. stocks got clobbered, Bitcoin nosedived, and even currencies like the Mexican peso stumbled as traders scrambled to unwind positions. These are systemic shocks, folks. When the third-largest economy on the globe gets hit like this, the cascading effect is wild. You better hope your portfolio was diversified or you took a hit, too. $150 billion was wiped out of global markets in a single day following the yen's fluctuations. And that's just the tip of the iceberg. Let's zoom out for a second. Why is all this happening? The sheer fragility of the global economic network is on full display. Remember, back in 1990, the United States held 21% of the world's GDP. Fast forward to today, and that's fallen steeply, only about 15%. Meanwhile, the G7 as a whole once lorded over 50% of global economic activity. Today, it's limped to just 30%. And trust me, this geopolitical and economic fragmentation is already costing unintended casualties. Washington's barrage of sanctions against Russia in 2022, aimed at strangling the Kremlin's economy, produced shockingly bad results. Putin's war coffers remain full, with Russia on track for 3.5% GDP growth in 2024, thanks in large part to ever-lucrative oil sales to India and imports from China keeping the country's industries humming. Not only have the sanctions failed to cripple Russia, they've also deepened the rift between the West versus the sprawling economies of the global South, which aren't exactly in Washington's pocket. Meanwhile, the US dollar, once the undeniable global top dog, is seeing its grip slip. In 2000, 72% of the world's central bank reserves were in dollars. Today, it's just 58%. Central banks are realizing that diversification from US dependency isn't just prudent but necessary. China's yuan, while far from the dollar's global heft, now handles a quarter of China's international trade, $1.46 trillion, according to the People's Bank of China data. This is a stark escalation in China's years-long push toward de-dollarization. Everyone's playing the long game, and yes, America is being left behind. Well, if you're a business owner or simply an individual curious about the stability of the future global economy, these trends should be a massive wake-up call to reconsider your approach. In today's shattered and asynchronous economic landscape, relying on global stability or, worse yet, the consistency of U.S. economic dominance is naive. Instead, smart businesses and investors should focus on local economies, stay agile, and brace themselves for volatility. For investors, rapid shifts like the ones we're seeing make or break portfolios in just weeks. Take, for instance, the British pound's wild ride this summer, as both overperformance and underperformance of the UK economy sent it soaring, then crashing, and all this because of a misalignment of the Bank of England with the Federal. Or consider how China's market woes were suddenly snuffed out in a matter of days as its Politburo committed to $300 billion worth of stimuli. That's enough sustained financial support to significantly add nearly 0.5% to global growth in 2024. For global investors, this made Chinese stocks explode upwards almost 10% in just 2 days. And let's not forget the crazy gas price swings we've faced this fall, driven by yet another geopolitical mess in the Middle East. War between Israel and Hamas alone made crude shoot up $10 in just weeks, to $80 a barrel. No one saw that coming, and no one predicted it hitting global supply chains so acutely. Now more than ever, whether you're charting a company's supply chain or building an investment portfolio, the world is no longer predictable through spreadsheets and linear growth charts. Things are chaotic. Adapt or perish. So, to wrap up, in the distorted, mismatched, and unpredictable world of fragmented economies, there's one key takeaway here: diversify and localize. Whether you're running a factory or a hedge fund, the old rules of US-led globalization and market consistency have been sunset. Without deep local knowledge, without the wisdom to decouple from outdated power structures, looking at you, Wall Street. You're navigating an economy ruled by fractured policies and geopolitical tensions that make central coordination virtually impossible. To those policymakers grasping at straws, the game's already changed. Asia rises, Europe stagnates, the US stumbles, and the world looks ahead to more chaotic phases of transition. So, get comfortable with uncertainty, folks, because, as always, when it comes to economic management, the light at the end of the tunnel might just be another oncoming train. Like, comment, and subscribe. Let's keep tearing down the smoke and mirrors of global economics, one issue at a time. Catch you in the next episode of Boss Economics World.